Hello everyone. Today I bring to you yet another video on editorial analysis. So students, in this video, I'm going to analyze an article that featured in the Hindu titled Belated Pivot on RBI, Inflation and Sustainable Growth. So students, this article is about RBI and its balancing of price stability and growth. So we all know, students, that RBI is primarily entrusted with the task of ensuring price stability in the economy, students, right? However, given this, the RBI has to keep in mind the growth objective also. So how does RBI juggle with the two? How does RBI strike a balance? Or for that matter, what should it really prioritize between price stability and growth? So this article, throws some light on this. So the article is titled Belated Pivot on RBI, Inflation and Sustainable Growth. So the key message of this article, the key theme or the central message of this article is that without curbing inflation, the RBI will not be able to promote sustainable growth, students, right? That means, the RBI will have to first tackle inflation. It will have to first get inflation within the targeted band. It will have to first ensure that the inflation is less or moderate, and then it should strive for growth, students, because according to the article, without taking care of inflation, without curbing inflation, RBI will not be able to promote sustainable growth. Even if there's growth, that wouldn't be sustainable in nature. So sustainable growth only comes with low or moderate levels of inflation, right? So students, the RBI's Monetary Policy Committee has acknowledged that its primary remit is, after all, to ensure price stability, right? Students, Monetary Policy Committee, it's an organ of the RBI. It's the core committee of the RBI that makes the most important decisions regarding the setting of the policy rates. I'm going to talk about that in a while, how, what it does, its functions. And so basically, this committee has acknowledged, students, that our primary responsibility is to ensure price stability, students. So like I said, there are, RBI has been mandated by the government of India to take care of price stability. But that cannot be done independently of the growth, students. The RBI has to keep in mind the growth objectives, right? Because let me explain you at this point that growth and inflation supposedly are seen as two contradictory objectives, right? That when RBI tries to achieve growth, right, it leads to some amount of inflation in the economy. And when RBI tries to curb inflation, it negatively impacts the economic activity and demand within the economy, because of which the growth gets compromised, leading to unemployment, right? So because these two are considered contradictory in nature, students, very often RBI, in fact, most central banks of the world are seen, struggling to strike a balance between the two. But every central bank needs to be clear about its primary objective, so that when they have to prioritize one over the other, when this becomes necessary and achieving a balance gets difficult, in such cases, it knows what it has to do, or it is guided by that primary objective. And in this case, the RBI, it has said that it has come to realize that its primary responsibility is to ensure price stability within the economy, students. Next, students, RBI Governor Shaktikanta Das was emphatic in stating that in the sequence of priorities, we have now put inflation before growth. Right? So it's not a question of what is important. We all know both are important, but what has to be prioritized? It says we would prioritize. The RBI governor has went on records to say that now the time has come that we will have to prioritize inflation before growth, students. More than 3 years after it prioritized growth over price stability in February 2019, and well before the onset of the COVID-19 pandemic, the RBI has pivoted back to its monetary policy goals of controlling inflation, students. So students, I mean, it was very clear right from the onset that RBI has to control inflation. But sometimes, the situation demands that the uh, economy needs to be sort of, spurred. You need to create momentum within the economy by increasing the monetary supply. And in those cases, RBI slightly relaxes its stance or its policy rates. So now students, RBI had on purpose chosen to do so, to put growth over inflation from the past 2-3 years, and this only increased in the backdrop of the COVID-19 pandemic, because the economy was reeling under, I mean, it was going through a slowdown and we needed to recover the economy. So obviously growth objective was prioritized to this. But now RBI has stated that now it's going to put inflation before growth, students. And like it was stated by the Monetary Policy Committee that price stability is a necessary precondition to sustainable growth, that RBI will have to first ensure price stability before it can target growth. Now, students, why all of a sudden there is such a huge drive to control inflation? What is it that RBI has become very particular about this now? So the thing is that the outbreak of war in Europe with its accompanying commodity price shocks to remind the RBI of the imperative centrality of price stability, right? Now, students, we all know that there's this whole outbreak of war in Europe, right, which led to price shock, students. Particularly, it impacted the price of oil, students. So oil is one commodity that has got spillover effects on all the other commodities, leading to increase in prices, students, right? So now this war has made RBI remind of the imperative centrality of price stability, the importance and the cruciality of price stability, students. Then the article says that less than 2 months after it rather sanguinely projected inflation to average 4.5% in the fiscal years to March 23, the MPC has raised the forecast by substantial 120 points to 5.7%, students. So basically, like about 2 months ago, RBI had, stated that the inflation is supposedly well within control. It is hovering at an average of 4.5%, which is manageable within the manageable levels, right? However, now students, it has increased that its projected inflation has been increased to 5.7%. That means, we are breaching the upper limits of inflation that has been the target that has been set by the RBI itself. So RBI has this band of 2 to 6%. So 5.67% is very close to that upper band, students, right? So now RBI feels that the time has come that it will have to get all its acts together to control inflation, because we are about to breach the upper target limit. And this even as it cuts its earlier projection for real GDP growth in the current fiscal by 60 basis points to 7.2%. Now, this is so interesting, students, that RBI has increased, please pay attention to this, RBI has increased its projected inflation, right, to 5.7%. That means inflation is growing. On the other hand, it has cut the real GDP growth forecast, students, by 60 basis points to 7.2%. Growth projections have been downward revised and inflation projections have been upward revised, which means that growth is not even coming at the cost of price stability. That in spite of inflation, high inflation being there in the economy, we've not been able to achieve growth, right? So why don't we instead control the inflation first? Isn't it? Because in any case, the only advantage of high inflation, which is supposedly high growth, that is not happening, right? So that means RBI has failed to achieve both, neither moderate levels of inflation nor high growth, students. The price of crude oil, which Mr. Das cited as the key factor that has necessitated the revision of the inflation projection, students, like I said, it is the, if you read the last point, the price of the Indian basket of crude had surged by about 25%, with Brent crude climbing by a steeper 30% in the same period, students. So Brent crude, let me tell you, So basically, it is a benchmark or indicator of like average price of oil per barrel, students. So Brent crude, because there are multiple types of, several types of oil depending on their composition. So there are three specific oil types that are taken into consideration as for oil price benchmarks. How do you benchmark the price of oil given there are so many types of oil? So they select these three oil, students. One is Brent crude, and there are two other. So now, students, because the price of Brent crude is increasing, students, right? The government has come to realize, the RBI for that matter has come to realize, that this would have spillover effects on other goods and services within the economy, leading to very high inflation. So this needs to be controlled. The RBI's deputy governor overseeing monetary policy, Michael Patra, had, on the other hand, at the last MPC meeting, starkly warned that central banks have a choice: either accept higher inflation or sometime or be prepared to be accountable for destroying demand. Now, look, this is a contrary view coming into picture. There's a contrary view. So one of the RBI's, monetary policy committee member, the RBI deputy governor himself, students, had warned in the last meeting that central bank have a choice. They would have to either accept higher inflation or let go of growth, students, or they would be killing the demand in the economy, right? That means that there seems to be a lack of consensus as to what the central bank should be doing. But that is very natural, students, because central bank has to, juggle with two conflicting objectives, students. So this is bound to happen, right? Policymakers have clearly realized any further delay in changing track would risk leaving the economy with neither growth nor price stability. But now, with inflation increasing, students, with high levels of inflation, it says that if quick action is not taken soon, the economy will neither see growth nor price stability, students, right? Just one more thing I would want to point here before I move ahead is that why this is such a dilemma at this point. Because we are seeing both. We are seeing low levels of economic growth also, given the pandemic backdrop. Plus, we are also seeing high levels of inflation, particularly because of the war outbreak that has impacted the price of oil. So now RBI has to fight both low levels of growth and high levels of inflation, right? So it is precisely because of this that RBI is confronted with this dilemma, student, which has been always there, but now it has only increased. Now let's quickly understand Monetary Policy Committee, students. So Monetary Policy Committee is a statutory and institutionalized framework under the RBI Act 1934 for maintaining price stability while keeping in mind the objective of growth. So MPC, basically, students, it is a statutory core committee of RBI that makes decision related to policy growth, policy rates, right? For example, we all know there are several instruments at the disposal of RBI to control monetary policy or to control monetary supply within the economy. Here, I've mentioned about repo rate, you have reverse repo rate, you have open, market operations, cash reserve ratio, LAR, liquidity adjustment rate, marginal standing facility, so their bank rate. So these are number of instruments, financial instruments, monetary policy instruments that are available with RBI to control monetary supply within the economy, students, right? And this is done by the Monetary Policy Committee, students. And it also determines the policy interest rates, particularly repo rate. So when we talk about policy interest rate, I mean, there are a number of instruments at the disposal of RBI, but when we talk particularly about policy interest rate, we mean to say repo rate because that is like the most important policy instrument required to achieve the inflation target. So basically, students, you have to understand this, that every central bank targets, sets an inflation target for itself. Like in India, RBI had set an inflation target of 2 to 4%. However, this can be, revised downward or upward depending on the situation and circumstance. So because of the In the past few years, we know first we had the US-China trade war, and then we had the COVID-19, because of which the economy has been in a slowdown, students. So when the economy is in a slowdown, when there is less growth, usually some amount of inflation can be allowed for to spur the economy. And that's the reason why RBI had increased the inflation target to about 6%, students, right? The upper limit, basically. Now, very quickly, students, I would just want to, so basically, we can have another video on all the monetary policy instruments that are available with RBI. We're talking particularly about repo rate and the reverse repo rate, students, given that this is the most important policy interest rate. It is the rate at which the central bank of a country lends money to commercial bank in the event of any shortfall of funds, right? So whenever there's a shortfall of funds or banks require more fund to lend out further to the economy, the central bank lends the money to the commercial banks at a specified interest rate. If it lowers this interest rate, right, the banks are able to get the required funds at a cheaper rate, at lesser price, and therefore they decrease their interest rate. The commercial banks further decrease their interest rate that they charge from the public, and that increases the money supply in the economy, right? And vice versa. That if RBI wants to restrict, students have to understand this, RBI wants to restrict the money supply in the economy, it is going to increase its interest rate, the rate at which it lends to the commercial banks. The commercial banks in return would increase its interest rates that it charges from public, right? And this would lead to reduced money supply in the economy, right? So repo rate and the reverse repo rate is the rate at which RBI borrows money from the commercial banks within the country, students. So basically, repo rate is the most important rate, policy interest rate used by RBI to control monetary supply, students. Next, students, very quickly, let's understand the dynamics between inflation and economic growth and the role of RBI in this, students. So like I have already told you that the primary objective of RBI's monetary policy is to maintain price stability while keeping in mind the objective of growth, right? So the amended RBI Act 1934 provides for the inflation target, right? And this target is set by RBI in consultation with the government of India. Recently, the MPC noted that central banks' accommodative policy stance may fail to comply with the inflation target, students, right? So the government, the RBI, we know, has revised the inflation target about 6%. But now, the inflation is going beyond that revised upward limit also. The inflation would soon breach the 6% limit also. And RBI has come to realize that this accommodative policy stance, what is accommodative policy stance, students? Read the next line. An accommodative stance indicates a willingness on the part of the central bank to expand money supply and cut interest rates, students, right? So what is accommodative stance, students? The willingness on the part of central bank to expand monetary supply by cutting interest rate. Just understand this, when RBI cuts interest rate, monetary supply increases and vice versa, right? So if RBI wants to increase monetary supply in the economy to increase the growth, to spur the growth, right? It will cut the interest rates, but this can lead to inflation. So RBI has come to realize that accommodative stance or its whole policy of relaxing the monetary supply is now sort of is a hurdle in its target to achieve, moderate levels of inflation or to curb inflation for that matter. Now, students, let's understand inflation. Inflation is the general rise of prices in the economy, students. Now, there's this whole debate around it that whether inflation is a good concept or not. I mean, whether is it a good phenomena? Should we allow some level of inflation within the economy? Does inflation has any benefit, or should we strictly focus on curbing the inflation, right? So it is a highly debated phenomena in economics, students. Many economists, businessmen, and politicians maintain that moderate inflation levels are needed to drive consumption, assuming that high levels of spending are crucial for economic growth, students, right? So it is a common belief now among businessmen, economists, politicians alike that some level of inflation is good for economy, students, right? It is very good for economy, some level of inflation, right? And this is because higher levels of inflation usually leads to higher levels of spending in the economy, higher levels of demand in the economy, and this leads to economic growth. So if a country has to ensure economic growth, it will have to adjust to some levels of inflation. And this is particularly required, read the next point, when the economy is not running at capacity. Students mean that when they are unused labor or resources, students. So when there are unused labor and resources in the economy, students, that means there is a scope to increase supply from the back end. And when, there is like increased demand matches increased supply and vice versa, right? That has moderating impact on inflation, students, right? So just understand this to put it in very simple words, that whenever when the economy is not running at its full capacity, or when there is a slowdown in the economy, right? Inflation theoretically helps increasing production, increasing demand, increasing spending, and hence leading to economic growth. More dollars translate to more spending, which equates to more aggregate demand. More demand in turn triggers more production to meet that demand, students, right? Now, on the other hand, there is another set of scholars and economists who believe that inflation comes with its own cost, students, right? It's a drag on the economy, and price stability is necessary. It's a necessity precondition for growth. That inflation is not good at. So students, there is a view that our economy works best when there is price stability, right? So what is price stability, students? Price stability is the condition in which the domestic currency retains its purchasing power by maintaining low and stable inflation as measured by CPI over the medium term. So basically, price stability is a condition when there is low and stable levels of inflation within the economy and the domestic currency doesn't lose its value. So we all know, students, when there is inflation in the economy, then what happens? Then our currency loses its value, right? Then students, some of the downsides of inflation have been pointed out here, that high inflation reduces the incomes and savings of businesses, students, obviously, right? If you have to shell out more, if you have to spend more on goods and services because of high prices, because of high inflation, that's going to negatively impact your savings, right? Reduce your savings. And this is going to be true for both businesses and households and the government, and drives an increase in production cost, students, right? So obviously, if the price of the industrial goods would increase, the production cost would also increase. The cost of credit would increase, the interest rate would increase. And all this is going to result in uncertainty over the future prices, students. Additionally, large inflation fluctuations create an unfavorable environment for long-term investment in the economy, right? Obviously, students, investors want certainty, guarantee for their return, students. But when there are large inflation fluctuations and volatility in terms of inflation, that creates an unconducive environment, unfavorable environment for long-term investment, students, right? So high and unstable inflation affects economic growth. So these are the two views. The first view that I shared with you was that some level of inflation is good, right? The second view is that inflation doesn't do any good, right? And the RBI will have to, take this call as to what it should prioritize, whether it should prioritize growth over inflation, right, or not, or or vice versa, inflation over growth or price stability over growth. And if it allows for inflation, what levels of inflation would be considered good level of inflation, enabling level of inflation that positively impacts the. So that's all for this video, students. I'll see you soon with yet another video. Thank you so much.